Hey, this is Abram Caballero again. Welcome back to the third video. Okay, let's get right into it. This one is term policies, the types of term policies there is. Okay, so the types of term policies. There's the first one that is annual renewable term, ART, also known as increasing. This means if it's annual renewable term, annually it's renewing. Annually, the client is getting older. So if it's renewing every year, as the client is getting older, what do you think that means? I'm gonna let you think about it for a second. If you guessed that the price goes up, that's exactly what happens. So as the person continues to grow in age and this continues to get renewed annually automatically, that means that it's the lowest cost of insurance possible. This one is the one that you're going to find that's going to be the least expensive one. But because every single year it's going to go up in price, it also makes it the most expensive one. Because at first it's super cheap. But then later, as you're getting older, it gets so expensive, so flippin' expensive that you cannot afford it anymore. Okay? That's annual renewable term, also known as increasing life insurance. Okay? Now, the second second option here is level term. Level means, and I'm going to give you an option. Let's an example. Let's say that you have a 30-year-old female. She's looking for $100,000 of life insurance, and she's going to get it for a period of 10 years. She would possibly pay, I don't know, maybe about $25 a month, $20 a month. So something like that, even possibly less. Level term life insurance means that the price is not going to go up. The price stays level for that period. Now, that period can be 10 years, it can be 20 years, it can be 15, 30 years, 35 years max, but it's going to be for that period of time. It's level, it's a flat rate. It doesn't go up, it doesn't go down. It's guaranteed. You're insured while you're paying it. That's for that period of time. When it expires and you try to renew it after the 10, 20, 30 years, then it gets more expensive because now that's your new age. That's known as your attained age. Your original age would be when you first got the policy. Your attained age is now how old you are. Now your new age that you just attained. So level term, flat rate over the 10, 20, 30 years. After that, it expires, and then you have to renew it or you just let it go. Credit or decreasing life insurance means, let's say that you finance a home, and this is what you're going to find in the study material. In a home, when you finance it for, let's say, 15 years, 30 years, 15 years, if you finance the home for $250,000, and that's what you have on your mortgage balance, $250,000, and you get a decreasing policy, it would be for the same $250,000 of whatever your mortgage is. But as you're paying down your mortgage is like the balance is coming down. It should, at least. So the credit policy, the way that it works is as your mortgage is going down, so is your life insurance, because you're only insuring your life for whatever your balance is, for whatever your debt is. When the mortgage is paid off, then your life insurance is no longer existent. It's supposed to follow, continuously change with your death benefit. So as your death benefit goes down, as your debt, your mortgage goes down in balance, so does your life insurance, but your payment stays the same. That is going to be level. If it started off at $50 a month, it's going to be $50 a month for the rest of the life of that mortgage or of that policy. And when it ends, you paid the same price the whole time, even though your death benefit was going down. Okay, so this is a little bit easier to explain. It's very, very simple to understand. Go over it again. If it didn't make sense, the more you listen to it, the easier it'll become to understand. Because I know this is like a totally new language for many individuals, like it was for myself when I first started studying this. The way that I did it was I wrote things down on a card. Now I would just, flip it with a definition on the back, and I would go over it. I did it for 5 nights, 5 days, 3 hours in the morning, 1 hour at night. I would just go over the definitions, practice material, and then on the 5th day, I went and I took the exam. So I hope this helps you out. If it did, go ahead and drop a comment or look forward to the next video. Go ahead and click on it. Look for it if you're wanting to learn about whole life, about the different types of life insurance, crediting strategies, and all that. You can find it.